structure for the deal that we're moving towards issuance of. And then finally, we want to give you an update on the financial picture of the deal, given the dramatic run-up in interest rates over the last 6 or 9 months, and how that's impacted the airport's ability to afford the project, what it does to airline rates and charges, and let you know kind of what we're thinking, given the fact that, to sort of read the last page of the book first, which is that with the interest rate levels being where they are now, we're certainly approaching the level where staff feels that we may have to seriously consider deferring the financing for at least a short period of time to see if the market improves. So with that, I think we'll start with the overview and update on the project itself, and I will then turn it over to Owen Thomas to do that piece.
Okay, Mr. Thomas, please proceed.
Okay, we've divided the project into 3 construction contracts in order to facilitate the construction. We're building the airside improvements first, which is constructing new pavement to support the aircraft as they're parked next to the new building. That project is under construction now. It's about halfway through and should be finishing up in January. The next component is what we're calling the temporary facilities, which will make ready the site to construct the new facilities, mainly the new terminal and the landside work, while we're continuing to operate out of the old terminal. That work has been bid now. We have a low bidder. We're prepared to award the contract once the financing details are in place, and we're hoping to start that work in January. The final component, the big picture, is the terminal building itself, renovating the historic portion, and all the landside work, the roadways, parking, landscaping. That work is out to bid now. We're expecting to get bids December 4th. So, at this point now, we're just out to bid, taking questions from contractors, and expecting to get bids in on December 4th.
Okay, sounds good. Thank you. Bob?
Any questions on the project schedule? I think that one of the things I wanted to point out is the delicate balance between the timing of the project schedule itself and the financing, because as Owen said, we've had this bid for the, I call it the dirt work, but what are we officially calling it? Phase 1, I guess, for some time. But we really are reluctant to issue or to award the bid and to issue a notice to proceed to the contractor until we're assured that we're going to have the financing in hand to pay for it. And so it's a delicate balance in terms of timing the financing with the bidding process and the bid award process and the notice to proceed process. As much as we'd like to be able to get this first phase of the project going, it's one of those things that we don't really want to start the project until we know we have the money in hand to finish the project. And so all of this is coming together over the course of the next couple of weeks as the bids come in on December 4th, I'm sorry. And as we look to, at least initially, tentatively plan to issue the debt in the shortly thereafter, basically the second week of December. So that's what we're looking at, and it has definitely been a challenge to try to keep these on tracks that mesh with each other so that we don't unduly impact one or the other, the project itself or the financing schedule. So with that, thank you, Owen. I'm going to introduce you to David Broadsley, who is the Managing Director of Kelling North Cross Nobrega. KNN, as we call them, is the city's financial advisor. They assist us with our debt issuance, and they've been our financial advisor for almost a decade now, I think, and they are working with us very closely on the airport deal. And what I've asked David to do today is to give you an update on the market conditions, and we'll talk also about the structure of the bond deal that we are currently putting together. I'll just, again, steal a punchline just to remind you that we did come to the full city council a number of months ago to inform the council that although this was an airport bond deal, we were seeking your direction and approval, authority, if you will, to structure this as actually as a general fund credit, with the general fund backing of the deal, even though every expectation is that the airport will be able to service the debt and will be responsible for the debt. But we felt there were reasons, which we'll get into in a bit, as to why it made sense to be a general fund backed deal. And frankly, given the credit market stress over the last couple months, that turned out to be a pretty good decision, because to have a general fund backed deal in the market as opposed to an airport revenue bond is going to, I think, help us at least a little bit in the market with the reception of the bond deal. So with that, I'll turn it over to David, and we'll begin with his presentation.
We just put together a few slides. The first slide is as much illustrative of what's going on in the market as sort of both cause and effect, but it's a look at the bond insurers, which is where we started seeing problems emerging a year ago, long before this was headline news. And there used to be 9 AAA bond insurers. 80% of the California bond market had bond insurance, and it was a major part of the landscape, our foundation, if you will. All of the old AAAs but 2 have been downgraded, some of them many notches. The 2 that are still AAA are that from the old days, Assured and FSA, are poised for downgrade, and except for Warren Buffett and his small ventures into the bond insurance market, there are really no more players left. And again, the reason why we like to start with that is it's both symptomatic of just the wholesale changes that have gone on in the municipal bond market, as well as one of the causes to those changes that has rippled through our business. Next page is just a few bullet points on the what's going on in the market. On the investor side, the market shrunk. There was a lot of, well, we're seeing less interest in the classic institutional buyers, the mutual funds. There was a lot of, we call them non-traditional buyers, hedge funds, these structured instruments that were huge players in the markets the last couple of years and were a major factor in keeping interest rates low. They've all unwound for various things. And the only thing that's really been positive about the bond market in the last few months has been the retail buyers, because interest rates are so high, people get reattracted to municipal bonds. So unfortunately it's good news, bad news. They're there to buy bonds, but they're buying them at rates that were higher than the institutionals. We also have the problem, it's a supply-demand problem. We mentioned about the demand being down, the supply is up. A lot of folks are finding themselves in the same situation you are, projects that have been in the works for years. Now they're getting ready to come to market, and they're kind of hanging up waiting to see what happens. And you may be contributing to that overhang as well, getting the decisions that get made here. But that's been a factor in keeping rates up, as well as I'll call them institutional dumping. The AIGs, which everybody's familiar with, they were the single largest holder of municipal bonds. They're unwinding their portfolios. That's secondary market supply, but it has the same effect. So this is the world that we are that we're living in now. We can go to the next slide. Just to give you a graphic, the chart on the right shows the relationship between an index of municipal bonds and an index or the treasury bonds, taxable versus tax exempt. And on the left, you see what you would expect as normal relationships, tax exempt rates being, say, 80% of taxable rates. You'd expect them to be lower, their tax exempt income. And you can see what happened in the fall. We had this crossover where tax-exempt rates were 120, 125, 135% of treasuries, both because tax-exempt rates going up and the flight to quality on the treasury side artificially lowering treasury rates. That's a very abnormal phase in the market, and it's just one measure of the cost of borrowing today. If you go down to the lower slide, though, you do get a sense that if you take a bigger perspective, it's all relative, and the rates are much higher than they have been in the last 5 or so years. You can see from a 20-year perspective, we're still below the median interest rate. So it's all, it's all relative, but it's good to have that perspective in looking at these things. Next couple slides, I wanted to show you One is the rates for the AMT market. AMT is the alternate minimum tax. Most of the airport bonds, even though they're tax exempt, aren't fully tax exempt. Taxpayers who pay AMT, which is becoming an increasingly large share of the tax-paying public, especially the bond buying part of the tax-paying public, they have higher interest rates than regular tax-exempt bonds. And you can see what's happened to the rates over the last year, up significantly. And that sub part of the market is one of the factors that will cause people to have some pause about the current market conditions.
David, if I could?
Yes, please.
I just wanted to make sure that we understand the AMT issue, because that's going to come into consideration as we talk about the bond structure in a little while. But as David said, these are tax-exempt bonds, but the interest, when an investor buys these bonds, the interest that they're going to earn on these bonds will be subject to the alternative minimum tax. And so for many high-income, high-wealth individuals, in a sense, these are not tax-exempt bonds because they're subject to the AMT, and the interest they earn on these bonds has to be included in their AMT calculations. And so there's always been a premium, if you will, over a straight non-AMT tax-exempt municipal bond, versus that's always been at a lower rate than AMT bonds, where the buyer has to include them in their AMT calculations. What's happened, I think, is that spread has widened over the last couple months.
Yeah.
And
Well, certainly since the collapse in September. In fact, there's been very little activity in AMT. So one of the challenges we've had is not only are rates higher, but we're not exactly sure what rates are because you judge interest rates by market activity, and when the market kind of crunched to a halt, you didn't have activity to monitor and to measure. So that is one of the challenges right now.
We have a question here, David.
Oh, yeah.
Just on that issue, I assume that this is one of the fundamental questions you want our feedback on this afternoon. Is there still a market out there? I mean, we're not sure what the rate will be, but how easy or hard do you think it's going to be to sell these if they're not the product of choice at the moment?
Well, I mean, the sort of glib answer, but I think it's the right answer, is there's always a market at the right price.
Well, yes.
And that's, yeah. And,
However.
Yeah, but you exactly. So right now, we've gotten some mixed signals. There has just started being new entry into the AMT market with new issuance. One of the deals we looked at was frankly fairly expensive. There's other data out there that suggests that maybe that was a bit of an outlier, and we're hoping that by the time this has ripened sufficiently for market, that the market will be a little more robust. But that is the problem, and as I'm sure you know just from reading the news, this is such an unprecedented sort of market environment that all that we have learned in our working lives, I've been doing this for 28 years, is somewhat of marginal relevance. I think you would have had to be doing public finance in 31 or so to have any real experience, and there aren't that many of those left in the business. So everybody's trying to be honest with the reality of things. The good thing is the market is coming back to life generally. Mm-hmm. We saw huge run-ups in rates, then we saw some huge run-down in rates. The same kind of volatility you see in the stock market has been affecting the bond market, which means they're all, it's scary as a ride, but there are opportunities and windows of opportunity to get in there. Bob mentioned, not to get too far ahead of ourselves, but the structure here with the city's general fund wrapping this. It was originally done to increase your lower your cost of borrowing, increase your leverage, incrementally. Now it seems incredibly prescient because, I'll show you in a moment.
I didn't want to jump way ahead. I realize that that's sort of the end of the discussion, but if you could, I appreciate your answer.
Yeah, okay.
For now, thank you.
Sure.
Follow up and close that discussion on the AMT, because I've been asked the question, well, why are these AMT bonds? And the answer to that is because the tax-exempt nature of bonds is determined by the use to which the bond proceeds are going to be put. And because these bond proceeds will be used for a public facility, an airport terminal, however, it's a public facility that will be rented and used primarily by profit-making enterprises, i.e. the airlines. and that is the logic or illogic, if you will. And Councilmember Falcone and I have had this discussion.
I called it goofy, but you know, a technical term.
But because of that, these are AMT bonds. And last thing I'll say, and this is jumping ahead a little bit, over the last year as we've been preparing for this project and bond deal, the interest rate that we used as kind of our benchmark was 6% for this deal. All the planning numbers were based on 6%. And frankly, we thought that that was a very reasonable number and that maybe even a little on the high side, that we were being conservative. Well, now we've looked at rates that are, depending on the scenario we look at, that are as high as 7.5%. And that difference in that interest rate adds $600,000 to $700,000 a year in debt service. And that's a lot of money. And so that's why this is now a deal which is not quite as straightforward as it once was. So,
Yeah.
Sorry, David.
So it's good. Okay, let me show you just a couple more quick pictures. This is another look at curves, and it starts with taxable GOs, and then you go to tax-exempt GOs is the lowest rate, straight revenue bonds, the AMT bond, and the taxable bonds. And you'll see in a moment there's some taxable debt as well. So it just gives you a perspective of the range of rates that we're looking at, and they're all higher than they would have been a year ago. Next spread is actually technical but interesting. It's a snapshot of credit spreads, the difference in rates between a double A and a single A, a triple A and a single A, excuse me. And as you can see, back in about a year ago, the spreads were relatively narrow between that difference in credit ratings, 22 basis points. And as we've gotten into the credit crisis, credit spreads have widened greatly, and you can see, just huge jumps in credit spreads. This shows you the value, if you will, of the city's general fund wrap of the credit. And I can't remember when it was we brought this forward, but we were talking about it at the left-hand side of the chart, and it made sense on the left-hand side of the chart. This is the comment why it is so prescient. In this market, it's a lot of money. It's a lot of money saved in the city, basically accepting that it can monitor the airport risk better than the market can, which I think is a reasonable assumption. You certainly have more control over those risks than a third-party investor. MT, okay, and this shows you the same thing too, the AMT spreads over regular GOs, and again, the widening of that as well. That's the problem we have with the AMT. You can see how starting in the summer, AMT started to underperform the market just tremendously. So that's the AMT challenge in a nutshell. The next slide is redundant, so I think we'll just skip that one. I wanted to just show you the bond structure for a second. Looking at 30-year bonds, as we've mentioned already, structured as a general fund obligation with the airport revenues, the expected source of payment. Right there, you see what is fairly level debt service with a gentle ramp. In a moment, we'll show you a more escalated debt service, and all of this is addressing the question that the rising interest rates have an impact on the cost to the airport, and trying to deal with that reality as well, and still trying to settle on the optimum debt structure. There's pre-funded interest during the construction period, which is mentioned on that. The other thing I wanted just to point out is the debt structure itself. The very front end, the blue in the bottom, is the taxable bonds associated with the rental car facility. Under the federal tax code, there is no exemption there, so that's 100% taxable. The green section are the AMT bonds for the terminals, which are deemed private activities under the tax code, but exempt private activities subject to AMT. And then, those are the PFC bonds in green, and above it are the AMT bonds that are payable out of general airport revenues. I'm sorry, that's not a tax distinction. That is just a source of funds, because our PFCs paying a portion of the debt, and then there'll be general airport revenues paying another portion of the debt. From the bondholder's perspective, this will just be one pot of money going out into three different pockets. The front loading of the CFCs, as you can see, it's above what you'll get in revenues. So effectively, the general airport revenues lend to the rental car project and then subsequently get paid back out of the ongoing CFC revenues, and the overall cost of money is brought down that way. You try to put the most expensive bonds up front because it lowers the overall cost of the deal. And I think that's, I'm sorry, no, we do have two more quick slides. This is just the same thing with a more steeply escalating debt service. One of the structures that's still being considered because to keep the cost down in the early years of the project. And then the final slide is three scenarios.
We have another question here, David.
Yes.
I'm sorry, maybe I'm missing it, but page 11 and page 12, these two slides that you just went over, they are based on different scenarios, but I don't see a number.
Oh, yeah. I'm sorry. If they correspond, yeah. The first one is scenario A, and the last one, I believe, is scenario.
But
Is it B and C? Is it 35 extended? Marion, do you know?
explain to me what the differentiation between the two are. What
Let me-
assumption have you
yeah,
changed?
Here's, and we'll, okay.
Okay. Sort of between.
Let me take a shot at that.
What assumption did you
Yeah.
change?
Here's the thing is that normally we would issue debt, and the debt service that we would pay would be level debt service over the full life of the bonds, just like, a car loan where you have the same monthly payment every month for the entire life of the loan. That to me is the preferred bond structure. The problem is that you're going to see in a few minutes that having a level debt service, because of the run-up in interest rates, makes the project very expensive for the airlines in the first couple years of the new terminal. And so one way to mitigate that is to structure the bonds where we don't have level debt service, but rather the debt service in the early years is either interest only or interest in a small piece of principal, but not as much as it would be if it were level. And so what you do is you ramp up the debt service over the first maybe 5 or 6 years to feather in, if you will, the impact on the airlines. And there is a cost to that. Anytime you get off the vanilla,
There's also a huge risk to that.
I'm not sure there's an additional risk.
Okay.
But I guess in a sense you're right, Councilmember Falcone, because the market will charge us a little more for that, and so that really is a risk premium in one way or another. But it's also the fact that obviously the longer the bonds go out, the higher the interest rate, right? A 1-year interest rate is lower than a 30-year interest rate. And the way we sell bonds, it's really not just one bond. We sell a series of bonds that come due every year, and it's actually an interest rate scale that goes up as it goes out.
Okay, thank you.
I guess the question that I would have is, I understand what you're saying, but does it make a difference to the airlines?
Well, we're going to
If
show
it,
you
if
that.
it doesn't, then we shouldn't do it.
I agree with you. I completely agree. And those decisions have yet to be made because it depends on the interest rate environment at the time we want to go to market. We do have to talk to the airlines again, and I think the plan is we've talked to them very recently, and the plan is to go back and talk to them again. And I agree with you wholeheartedly that if it doesn't make a difference to the airlines, then we shouldn't be doing it.
Doesn't this get back to the maybe it was your presentation of several months ago, where you looked at the costs, or maybe it was the airport presentation throughout California, and we looked at how our facility compares with others.
Yes.
And the other thing that comes to my mind is, are there other facilities in our market area that are also doing big projects like this? Or are we the only one?
Yeah, and I don't know, I can't answer that offhand, but I can tell you that we do look at the benchmarks that the airlines use to measure the cost of an airport, of using an airport, whether it's landing fees or the lease payments they make for their space in the terminal. One of the probably benchmark, and we'll look at this in a minute, is what they use is what's called cost per enplaned passenger. And it takes in the entire airport cost, landing fees, lease fees, and figures it out on a per enplaned passenger. And that's one of the benchmarks the airlines use. And we did bring you back then a whole range of comparables of mid-size airports that showed right now we're at the low end of that. So we do have some room. But we're going to get into those numbers in the next piece of the presentation.
Okay, good, thanks.
I just wanted to reiterate then that we're talking about a 30-year bond, which is backed by the general fund but is airport supported. There's a taxable piece to it that will fund the rental car facility, the quick turnaround facility, and then there's the tax-exempt AMT piece that funds the terminal. And that's really what we're looking at. That's kind of the basic structure of the deal. So,
One other thing that we haven't mentioned that I just like to mention is in looking at this, we have looked at the coverage of this bond from revenues as if you were a revenue bond buyer, and this is not a fully leveraged transaction. Meaning there is extra cash flow currently in the cash flows that provide coverage to operation, maintenance, and debt service. That's usually money used for pay-go ongoing capital expenditures. It's what a bond investor in revenue bonds would want to buy these bonds. Probably more coverage because it's a small airport, which is one of the reasons we originally got down this path. But it gives the general fund a margin of cushion as well between its obligation to make payment and its expectations of getting receipts.
We have one more question.
Yeah.
Thank you. One of the things we don't know yet because the actual project's out to bid is what the price will be when it comes back. And we know from other projects that some bids have come back lower than expectations. To what point do you see that potentially happening in this case, and will that make much of a difference? At what level, if it's 1 million, 10 million, because it's a big number here that we're basing all this interest on, and if you could comment on that.
certainly. Well, we certainly are hopeful that that the bids will come back in, and it'll be, given the bidding environment, that we will have bids coming in lower than engineers' estimate, and that will provide us with some cushion. And you're right, if we lower the sizing of the deal, then that lowers the debt service and it trickles through the whole way. But keep in mind what I said moments ago, which is that the current interest rates that we are possibly looking at are adding $600,000 to $700,000 a year in debt service, just in interest cost alone. And so it would take a massively low bid in terms of under engineers' estimate to offset that entirely. But that is exactly right. I mean, one of the keys is when those bids open is to see where they are, and if they're very, very favorable, then that certainly, I think, impacts the decision as to what we think is an acceptable. I mean, what we're looking at is what's the annual debt service, right? And that's a combination of the cost of borrowing and the cost of the project. And so that's really why we won't be able to make any call on these things until after the bids open, and then depending on the bids, then looking at the market rate of interest and see what's the balance there.
And I guess also making the determination of if the decision was to wait because the interest rates were not favorable, what the potential it could be further down the line in terms of what the bid might be further
Right.
down the line,
Well,
how much more that might be over time. So that's
That's true, although the good news is that in the bid that we've issued, we have, in the bid documents, require that the contractors be willing to hold their bid for 90 days. And so that really gives us, if we open on December 4th, that gives us really till March 4th without even asking for an extension. And so if we can't issue the bonds or decide not to issue the bonds in December, we certainly can then stand by and monitor the market throughout
and
January.
then grab it
and-
if rates become favorable
That's
at
correct.
that moment within the 90-day
Exactly.
period. Okay.
Without having to go out to bid again.
Yeah, normally we don't. We're not big fans of trying to second guess the market and market timing. And normally we would say, you award bonds when your project's ripened and you sort of accept that the market works out over time. It's hard to ignore market timing in this kind of environment, because there are opportunities and costs. The problem with it, of course, is that you just, for every time that you're brilliant in your market timing, there's the other time when you're completely wrong.
Okay, let's move along.
Thanks. Yeah.
Dan? I'd like to introduce Dan Oakshey from Jacobs Consultancy, who is Jacobs has been a consultant to the airport for a number of years now and has been an integral part of our financing team because they are the airport experts and airline experts and the business experts. And as part of the financing, one of their jobs is to prepare a feasibility report which looks at our market and all of the sort of industry stuff. And so Dan's going to go through some of the financial analysis that Jacobs has done, and we've given you the whole packet. And this is the packet that staff is working with. So you're seeing staff documents here. We're not going to go through them all. It's a little more detail, I think, than we need to make the points that we want to make. So we've picked probably, I think, 3 or 4 of the schedules after we get by the key assumptions piece that we'll go through. But we're glad to answer questions on any piece of it. So with that, I'll turn it over to Dan.
Thanks, Bob. We have, in fact, been involved in this project a very, very long time. It's exciting to see Santa Barbara getting this close to doing this terminal building. The terminal building, and I attended a meeting with Hazel presenting this financial package to the airlines about 3 or 4 weeks ago. And it was fantastic to see so much support from the airline group, your tenants as well. And particularly in this time period right now, there are a lot of cities in California nationwide that are deferring projects because of what's going on, partly because of the pain in the airline industry. And the airlines are your partners in this deal. They're tenants at the airport. But one of the things I've always maintained is that the tenants really shouldn't dictate the terms of tenancy. And I've been really pleased to see the resolve in this community to do this project. It's a great project. The airlines were overwhelmingly supportive of this project, which is good news. So we did do, in fact, this feasibility report that would show how the airport on its own, if this were to be an airport revenue bond deal, this report is just like we would do any other airport revenue bond deal and demonstrates that the airport can do this deal with coverage of 1.4 and 1.5 times. The cash flow is still really good. I'll walk you through the cash flow even after having paid the debt service and then what the implications are to the airlines and the tenants. Wanted to assure Bob and council that even under a sensitivity scenario where there's a downturn in traffic or a potential for downturn in traffic, we will show you how we don't believe that the city's general fund would ever be impacted by doing this deal, even at these higher rates. So we did do a couple of little pages here that give you a summary of the financing. The first page talks about the deal itself. Terminal building scheduled to open in 2 years. It's a 2-year construction project. If we sold the bonds in December, let's assume that it started January 1 or close to that. Now, we said here the interest rate was approximately 7%, and I think Bob's talked about the fact that most of the planning up to now, up until about a month ago, we were looking at 6% interest rates, and the interest rates have gone to 7%, and as he suggested, some of these runs in the last couple of days have been at 7.5%. We have been looking, and I appreciate your questions about the debt service. One comment on that, we have done lots and lots of airport deals over the last 10 years that weren't exactly level annual debt service for various reasons. Part of the name is cash flow. Part of the deal is sometimes growing into a facility. And in this instance, if you can structure the debt such that the debt service is a little bit lower in the first 3 or 4 years and has a gradual, and in this case, the gradual is like 1% over time. So it's not a huge jump in debt service in year 5 or 6. You have the ability to grow into this. Most of your other expenses are kind of fixed over time. And most airports today, revenues are growing faster than expenses. So I think the downside risk of a gradual deal is very, very slight, in answer to your question on that.
I'm sorry, did I just hear you say that revenues are at airports are growing faster than expenses?
Generally. At airports,
Is
not
that the
airlines.
airport facilities as distinguished from the airlines
Exactly.
themselves? Thank you.
Exactly. So the bond structure is that they've just walked through would be partly paid from airport revenues, partly paid from passenger facility charges, and partly paid from customer facility charges. So as David talked about, the rental car piece would be paid for the customer facility charge, which comes from rental cars. Passenger facility charges, so it's approximately $60 million in principal that would be issued. $26 million of that would be paid. The debt service would be supported with PFCs. About 25, almost another $26 million would be supported purely by airport revenues. And then the last piece would be supported by customer facility charges. The annual debt service on this deal that we're looking at right now is approximately $4.6 million a year. And again, those numbers, have been changing, rapidly, working with underwriters and financial advisors over the course of the last couple of weeks. But these are the four sources. And actually, some of the debt service schedule, there's interest earnings on a debt service reserve. And that's one of the things that I think is important for council to realize, is that the way this deal has been structured, if they sell these bonds, right out of the proceeds of the bonds, there's going to be $4.6 million or whatever the debt service turns out to be, a debt service reserve sitting in the bank, funded right out of the proceeds themselves. On top of that, the airport still has surplus funds available. It has an operating reserve fund, which is 3 or 4 months of operating, which today means it's about a $4 or $5 million fund. And then it also has a capital improvement reserve. So the airport has good cash and good reserves to support this thing even in the worst of times. Expenses are, in our model, 5-year model through 2013, grow with basically inflation, so that we're looking at 3 and 4%. And we've really challenged the airport to hold the line on expenses and tighten their belt as best we can as we look forward, going forward for the next 4 or 5 years. Then ultimately, the airlines here, they pay landing fees to land their airplanes, and they pay terminal space rents. And one of the things that we tried to do in structuring this deal go forward was to pay rates and charges that are very close to what they're paying today. So in fiscal year 2009, Karen and Hazel are getting ready to implement a $1.98 landing fee. So our target for going forward was try to come up with landing fees that were pretty close to $2. And that's what we were able to demonstrate to the carriers, that we could do that all the way through the forecast period 2013 at the 6% interest rates. I'll show you the difference, at these 7% rates. They also are paying today close to $70-some a square foot in the smaller terminal building, and so we tried to structure this so that they would be paying in the 70s for the terminal rental rates, and we've been able to do that too. Now, they will be leasing triple the space, so and that's something that they realize as well. So the airline payments per enplaned passenger in the model that we're going to go through get pretty close to $10 per enplaned passenger. And I'd be happy to answer any questions that you might have on that topic. So we're going to skip this next.
And just roughly, how does that look around the West Coast?
It's for airports of this size, it's not uncommon for that cost to be 10 and higher. A lot of smaller airports where that is the case. 400,000 enplanements in an airport. Many airports have cost above that.
What do the big airports run?
It's so dependent. It's so dependent on the financial structure, and I've gone to conferences for many years and talk about benchmarking. Everybody wants to know how they stack up. You really have to have your own report card. That's the one thing that I would say. Every community kind of has to have their own report card. I've got a metric at the end of this presentation that I think is more important for you guys to look at than cost per enplane passenger. But Harrisburg, for example, is in the $15 to $16 range per enplane passenger. Brand new terminal building that they built a couple of years ago. Your project at 10 comparable airports. Los Angeles is almost 10 today, and that's a big airport. Atlanta, which may be the biggest airport in the country, is only about $4 because they're running 300 million. They're running 300 million people through there a year. So a lot of it, it's the cost and the structure how it's cost, but it's the denominator, the units that you use the measurement. You guys roughly are at a base of 400,000 enplane passengers, and that's what we need to focus on here. What's 400,000 enplane passengers into the airline cost? We're going to take a quick look at Exhibit A1, but this entire financial package is what goes into the feasibility. It starts with the project costs. Exhibit A1 shows you guys the funding sources that we've been talking about here, and it shows the ability of the airport to fund not just the terminal project, but one of the things that we always believe is important is funding everything that you've got to do at the terminal, not lose sight of everything else that's going on. This funds all of the projects that they've contemplated needing to do over the course of the next 3 years. So we're calling this a 2009 through 2011 CIP program. You'll see that they've anticipated $4.2 million from AIP grants that are discretionary. On an annual basis, we get entitlements at our airports, and that's almost $12 million. Over time, you can see that $6 million of department funds are going towards paying this project. They already had about $800,000 collected from CFCs since. Go ahead. Exhibit A1. A1. Just showing all the funding sources go across that'll pay for the $73.5 million worth of projects over the next 3 years. We skipped A. So there'll be a $7 million piece, will come from this taxable, supported by CFCs out of bond proceeds. There was almost $5 million of PFCs that are, paying for brick and mortar, what we call pay-as-you-go basis. And then about $19 million will come from PFCs that'll support some of that debt. And then there's the AMT piece, the revenue bonds. About $19 million will come straight from revenue bonds that'll be paid out of revenues. So those are the funding sources of how you're going to get the $73.5 million. David Brosley already really talked about Exhibit B, but it gives you the breakdown on the $60 million of premium that would be the $60 million bond issue. And again, if someone were to ask you guys a question, here's the quick math, and he's given it to you a couple of times, but the difference between 6% and 7%, 1% on $60 million is $600,000. It's easy, and that's kind of what we were looking at a month ago versus what we're looking at today. So anybody asks you guys, so we're looking at a $60 million deal, and 1% interest rate on $60 million is $600,000 extra debt service a year. That's the easiest way to describe what's happened over the course of the last month. Exhibit C shows the debt service and how it all works out. Exhibit D is the O&M at the airport for the next 4 or 5 years. Exhibit E is a summary of all the revenues at the airport, including non-airline revenues, airline revenues, everything that goes on at the airport. E1 shows you how you calculate those terminal rents and keep them in the $75 range. E2 is the calculation of the landing fee. Exhibit F is always, no matter what business you're looking at, it's the cash flow exhibit, and I think it's the one that's most germane to you guys. It shows historically where you were in 2008. It shows you where you are at your 2009 budget. That cost per in-plane passenger today is a little over $5. Your airport staff and you as a city have done a tremendous job of working with your airline partners to keep their costs down, for the last many, many years. Over the forecast period, we've still tried to introduce this project and put the debt service in the rate base in such a way that the airlines were affected as minimally as possible. They were all appreciative of the approach. So what happens over time is you'll see that the airlines in 2012 in this exhibit and in 2013, we would get $4.3 million from the airlines in space rents and landing fees, $4.3 million in 2013. That translates into just under the $10 that I referenced before on a cost per in-plane passenger. So your in-plane passengers in 2012 we're projecting to be 438,000. You divide it into that $4.3 million that they're going to pay you, you get $9.95 per in-plane passenger. So that's how you do the calculation. And again, you really need to write your own report card when you talk about this because the circumstances differ at so many different airports. You guys have one very fortunate thing. You've got a great airport staff, but this airport has been fortunate to have a commercial and industrial area that makes really good money. There are a lot of airports with 400,000 in-plane passengers across this country that don't make the money that you guys do from that industrial area, which really helps, keep cash flow going and really helps you guys to have the ability
I understand
to
what
do
you're
this.
saying, but some of the regional facilities in our area here are either cutting way back or closing down in some cases. I'm talking about Santa Maria and San Luis Obispo. Aren't we having problems up there? So I guess my question to you is how relevant is $9.50? Does somebody in one of the airlines look at that and say, well, that's just too high, it needs to be $8, or we can go as high as $12? I mean, I don't have any sense about what makes a decision to no longer land. What triggers?
Okay, I can. This really gets at the crux of the final exhibit. But I've been doing this for 25 years, and so I'm always across the table from the airline reps that come to town that want to minimize landing fees and minimize space rents. They're very good at it. They're very good at that. That's their job, is to minimize that part of what they do, their business. But if one of them came here today and looked you in the eye honestly, he will tell you that an airline has never made a decision to serve a market based on cost. Okay? Never made a decision to serve a market based on cost. Airlines make decisions based on revenue. Airlines make decisions to go into markets and fly airplanes into market because of revenue. And we'll get that. But as council people, it's a fundamental thing to understand in this business. Because airlines would like to tell you that the cost of your new building is too expensive. And it doesn't have to be Santa Barbara. They use that at a lot of places. The cost of your facilities is too expensive, when in fact the only decision that they make is based on revenue. And we'll show you this in just a second, why it's important. Importantly on this, the last couple of things that again, from your standpoint, I think are important is if you take the airlines $4.3 million and you add it to the other $12 million that the airport's going to make, you're going to make $16.8 million in 2012. And that's the first full year of debt service in this bond deal. Your M&O costs you show being paid, then you show the debt service. And the airport still in that year is going to put $148,000 into its operating reserve fund and top that off and still generate a surplus of $848,000. Now, these surpluses at our airports we put back into the deal. So Hazel and Karen are counting on making, close to that amount of money because that's something that they're putting back into the funds that they go back in to fund the projects, not only for this 3-year period, but going forward as well. So there's still some room in this deal at the higher levels of debt.
When you have fuel fluctuating in the percentages that we've seen in the last 6 months, doesn't that have any part in this thing?
Not really for you guys as airport sponsors. I mean, it's something totally beyond your control. I mean, the price of fuel really affects your airlines and their ability to make some profit. The expectation is right now the airlines have a chance to make money in the fourth quarter at the lower fuel prices that are in existence today.
Got it. But what if in the second quarter of 2009 it skyrockets back up again? Then we're back in the soup, aren't we?
Well, I don't know that you're back in the soup. I mean, the airline industry may be back in the soup, but
if it's true what you said, that revenues is the key and not cost, and their revenues plummet by 25%, doesn't that impact on their desire to want to fly in here? That's what I'm trying to get a handle on.
I'm not sure that, one of the things that the airline industry has done over the course of the last 2 years, and we talk about this quite a lot in the feasibility report, we've gone in and demonstrated how many seats they've taken out of your market and how many seats they've taken out. And the buzzword in the industry, they've reduced capacity, which basically means they've cut back on planes, they've mothballed planes, so there are fewer seats available to you guys every day you want to fly out of Santa Barbara. Interestingly, the demand in many, many places across the country, the demand for people to get on airplanes hasn't really abated. People still want to get on airplanes. To the extent that traffic in some markets has dropped off by 2% or 3% or 4% is a much smaller percentage than the fact that the airlines took 14% of the capacity out. People still want to get on airplanes. They just don't have as many seats. That's what's happened. I would argue that the airline industry right now has gotten back to the point where they couldn't take out a lot more capacity. They've taken out 14%. So I think that they've put themselves in a position where they can operate as lean as possible and cope with $100 and $120 a barrel oil prices. Everybody expects that they can make money at 60 and 70 and 80. That's what they've tried to set themselves up to do. So let's hope that oil prices stay low for the near foreseeable future. If they don't, no one's that clairvoyant or has a crystal ball about what the landscape might look at if you're operating in that $120 environment. The possibility is there'll be more rationalization of airlines, and you might see some come and go. So that's why we did a sensitivity study in this that show you what would happen if you lost, they're 10% of your market. And so we demonstrated what the cost would be and the implications if that happened.
Well, that's why they hire us, I think, and Karen and her staff is to worry about that, because we make plans today based on oil at whatever the barrel is today, but if it shoots back up to 140, I don't have much of a feeling about, and I don't know that it won't do that. I think it could be back there in a year or 2 years easily. I don't know what that impact would be on the airline's revenue unless their desire to land here. You see what I mean? There's a definite relationship here between their ability to generate revenue and their desire to land at an airport like us. And we're making projections here that go out to 2013 and beyond. So that's the dilemma, I think.
Well, let's talk about, let's go to the last page and let's talk about the airline revenue part of the equation. We've got a little, it's called Exhibit H. We've got a little bar chart. And this is actually very simple math to do. Down at the bottom, we've got something called total airline payments. Again, that's what they pay you guys for space rents and landing fees. And we've shown 5 years of history here at this airport. We've shown the number of enplaned passengers. You can see that growing from 400,000 up. You know, you peaked at like 436. So I would argue that based on the population and the economics and demographics of Santa Barbara, you guys are always going to have a core 400,000 people that would want to get on and off an airplane based on the economy and the demographics and the population, which grows slightly over time. So you should always have 400,000 people want to get on an airplane. The average one-way fare in here is much higher, as you guys all know. The average fares into this market are considerably higher than the national average. But take the one-way fare, as it's grown over time, it's almost $220 one way out of here right now. When you look at all the markets, you can look at all the OAG and the DOT data, and it suggests that the average one-way fare out of here is today $219. So all we do simply is take that $219 in the budget year 2009, 219 times 413,000 enplaned passengers. The airlines this year will generate, we estimate the airlines in fare revenues will generate $91 million. Okay? That's why they decide to come here. They're going to pay you guys $2 million this year. $2 million in landing fees and $2 million in space rents. The cost really isn't a factor. It's the $90 million that they're trying to get. Now, the price of fuel is a different thing outside of the equation because that's an operating cost that would dip into their $90 million that has nothing to do with Santa Barbara, quite frankly. Now, over time, in 2012 is the year that your debt service will come online. So let's just skip forward to 2012. And we've shown you what the effect of them paying the debt service and their rental rates and their landing fees. And we've estimated that they'll pay you $4,358,000 in that year. We also estimate that they would generate almost $104 million that year. Their net here would still be almost $100 million, despite the fact that their cost per enplane passenger is approaching that $10 mark. Now, again, you know, I think when you look at it this way, you can see that the cost really isn't as big a factor to them serving. If the cost went to, so here's the scenario, what I would call maybe one of the worst case scenarios here is if traffic fell off another 10%, they took another 10% of seats out of this market, and sir, maybe it's because of oil prices or some other things that are happening in an economy. We estimated that the cost per enplane passenger might go as high as $12.50. The airlines would have to pay you in that scenario a little over $5 million a year, but they'd still be taking $99 million out of here in revenue. So, I mean, that's the play in Santa Barbara. There's 400,000 people, kind of come hell or high water, want to get on an airplane here in Santa Barbara, and at these rates, the airlines, what we're talking about is $100 million on the table.
So maybe what you're saying is that the nationwide macroeconomic factors facing the airline industry are more important than the specific micro factors facing us here in Santa Barbara, so that we don't really have to worry so much about cost of airplanes or cost of fuel or something like that, but they might have to at a national level.
They definitely have to at a national level, and you know there are some times that they'll make decisions where there will be certain spokes in this country that'll lose air service more than other places.
So if I could follow up, because I was having the same questions, that we're looking at revenue assumption. We're looking at doing this project and to pay for it with revenue assumptions based on the number of planes basically going in and out with passengers and the revenues based on the in-plane passenger fee. And we're making the assumption that the same airlines are going to be here and come and go, and they might fluctuate a little bit here and there. And although they might be seeing a revenue source at Santa Barbara Airport, there's still the bigger picture of how each airline in and of itself is solvent nationwide. So, for example, if United were to go bankrupt or try to change their whole business model completely up on its head, that would have a huge impact on our airport because it's a big carrier, as opposed to Northwest that does not come, or Southwest that does not come to Santa Barbara Airport. So there's this whole airline industry issue, but then it goes by airline to airline to airline and how each of them are working, and we're making assumptions based on the current airlines that are servicing our airport.
But the
here.
best, you're absolutely correct. So one of the things that we've always talked about is, again, go back to the economics and demographics of your locale, which you guys all understand and know very well. And let's still make the assumption that 400,000 people want to get on an airplane here. And let's assume that United goes out of business here. So you can't fly necessarily to L.A. the same way you did, or San Francisco, or a couple of those jumping off points to go to other destinations. But I would maintain that over time, it doesn't matter what the color is on the tail of the airplanes that are serving this market. 400,000 people want to get on an airplane here. They're willing to pay way over the national average to do it, and the market is $100 million. So what you would expect to happen is, if a United pulled out for various reasons, which have nothing to do with Santa Barbara, at some point in time, somebody will fill that void in this marketplace. That's the way that it would work. And we actually just have an example of something that happened here just in the last 6 months.
Between ExpressJet and Horizon Air.
ExpressJet left, and you guys had a really nice market going back and forth to Sacramento. And Horizon was smart enough to just jump onto that. So again, I think you need to look at your own locale and your own situation.
Okay. And I don't mean anything against United. I fly them all the time. So,
it's just a good
That's an
example.
important. I mean, I think for us as a finance committee, but also for anyone listening, about making these assumptions of how we're going to pay for a massive terminal project, we need to look at not just the current scenario, but the what ifs and the worst case scenarios. And I think you've answered that question.
So the last piece that I wanted to just walk you through on this particular page is that you can actually back into the cost, or you can back into the affordability of a project if you do the math from this airline side. Because you know what the enplanements are at a place, and you can guess what enplanements are going to be over the future, and we have good data on what the fares are. So you can do this math about what the revenue picture is at a place. We have always maintained that what we call the range of reasonableness to get in airline payments is 4% to 6% of that total airline fare revenue generated. Okay? 4 to 6%. You guys, if you look historically, down at the bottom of this page, it's 2.3%, 2.3. I mean, you guys are so low on the charts. You've done such a nice job of taking care of your airline tenants here and provided low cost to them. You know, at the higher interest rates that we're looking at and the debt service, which is more than we'd like to see, this deal is still an incredibly affordable deal to the airlines. Even at the rates that we've shown you, if they paid you that, it's 4.2% of the revenue that they're generating. 2013, it's 3.9. If we were asked to come in here and you guys had the resolve and you said, you know, I want you to negotiate a new airline deal, push as hard as you can, you know, I would tell you you could get 5 and 6%. I would tell you that you could get $5 million or $6 million a year out of the airlines. Now, in this environment, that would be really tough. But what you guys are asking for is extremely reasonable, and it still looks incredibly affordable.
Yeah.
Well, that just begs the question. Why are we not going slightly higher? Maybe not 5% or 4%, but if we're going to end up at, what are we, at 2.3 or something like that?
Well, you're
why
not
are
going
we?
to end up there.
We're not.
You're in that 4% range
3.9
now. So
right now.
We are, but
Yeah.
we're still well below.
You're in a range that I would still say is very reasonable.
Okay,
right.
all right. So it's reasonable, and we shouldn't get greedy, and it's all
Right.
It's all good. Okay.
Right, it's all
right. Well,
Here's the
these
deal
These are
again.
tough times. If they're making $100 million and they're paying us, 4 to 6% of that, and there is going to be somebody who steps into a vacant shoe, then
Now that, just so you know, that, I mean, while we would expect that would happen, you can't exactly guarantee how soon
No,
that
you
happens, but
can't.
somebody would fill that void.
absolutely. If your assumption, your base assumption, that there are almost 500,000 people here who want to take a plane from here and will pay a premium to do so, if those two basic assumptions are really correct historically, then the question is sort of, well, why are we being so lovely about it? But if it's reasonable at this point, then given these times, that's good enough. I guess I had one question back here. Oh, in terms of how you and I realize this is the previous and the next discussion, but if we do the regular leveled debt service, that's one thing. If we don't, then I guess when I said risk before, that spoke to the possibilities in these scenarios of interest only or interest plus a little premium, or that there is some sort of balloon payment that
No.
comes looming down the
No.
pike at some point. I don't want to see any of that.
The way this is structured, it's actually 1%. It's very slight gradual debt service to make up for what you kind of didn't collect the first 3 or 4 years.
I
So that's how
understand
it
that,
works.
but there are always hidden snakes
No
in the
balloon
grass
payments.
that
No.
Fully
happen.
amortized.
So.
No balloon payments.
Okay, thank you.
Okay.
No interest the first 10 years. Countrywide is actually the lender.
Countrywide, that's who we want to go with. There we go.
Mr. Chair,
Okay.
the last
Mr.
comment I want to
Pearson.
make on this is that we've referred to, the airfares out of Santa Barbara being maybe higher than the national average, but I always get a great deal when I fly out of Santa Barbara Airport. So I just wanted to.
You do, huh? See what's going on here.
Well, you also have to count the price of going to LA and paying for the car while you're there and the hassle and everything
Right.
else, and it almost pays for itself when you leave out of Santa. So fly out of SBA. Right.
Okay, Mr. Pearson, do you wish further comments on this topic?
No, sir. Just as a reminder, we'll be making a similar, somewhat more abbreviated presentation of the same material to the full council next week. And then on the 25th, 2 weeks from today, we will be before the council asking you all to adopt the paperwork authorizing the bond deal.
Okay, thank you. So shall we move to the task force report?
We should. Yes, sir.
All right, let's bring the new crew up here. We'll take a couple of minutes break while we change. Public comment after the presentation by the committee, or
Yes, sir. I think that would be
shall we
appropriate.
arrange for that at that point?
Yes, sir.
Okay, fine.
Mr. Chair, members of the committee, again, Bob Pearson, Finance Director, and the second item on the agenda today is an item that will begin the Finance Committee's review of the report and recommendations of the council-appointed Infrastructure Financing Task Force. As you know, just quickly by way of background, in January of this year, the council appointed 7 community members to constitute the ad hoc Infrastructure Financing Task Force. To look at the city's current capital planning processes and recommend steps for improvement, review the identified capital needs to ensure that they accurately reflect the needs of the community, to review the city's overall financial condition and situation and make recommendations for improvements, to review the city's budgetary practices, reserve policies, and capital financing strategies, and to make recommendations for improvement, and recommend specific steps to the City Council on how best to meet the current and future capital needs of the city. And the task force, as you know, worked very hard, and that work culminated on October 21st with their presentation of their report to the City Council. And at that meeting, as you know, the council referred the report and the recommendations to the Finance Committee and has asked the Finance Committee to review those recommendations and the report and to recommend to the full council in conjunction with staff, an implementation plan and timetable. And so this is really the first step, and staff fully expects that we will be back before the Finance Committee many times over the next couple months to talk about the various individual recommendations of the task force and work with the committee to assist you in developing your recommendations to the full council. So we have, as part of the agenda packet, staff went through the task force's recommendations, and we tried to take a first shot at grouping those recommendations into a number of categories to facilitate the consideration of those recommendations. And that was, as I said, attached to the agenda report in your packet. Today, we also have with us two members of the task force. We have the chair of the task force, Dick Jensen, and Dudley Morris, who was a major drafter of the report, and they have prepared for your consideration also a summary table of the recommendations with some comments. And at this point, actually, I'd like to turn it over to the chair of the task force and allow him
Before he starts, I want to just make one kind of overall comment. When Mr. Armstrong and I began talking about this project, which is more than a year now, or about a year, I guess, we had some idea about what we were looking at in terms of the general fiscal markets and the situation the city would be in. The situation is now quite different. In fact, it's amazingly different. I don't think I could have projected how rapidly things fell apart in this fall. And so that makes the way that we look at this report in some ways makes it more important than it ever was. But it also makes part of it difficult for us, more difficult than it was. So I just want to start with that context and then turn it over to Dick.
Thank you. The couple of things that we wanted to do was to make sure to thank the City Council for appointing us. Our 7 people had a lot of fun, and that sounds kind of funny for something that's a volunteer effort, but we didn't take anything for granted. You asked us to look in 5 different places and to answer a lot of different questions, and we felt that we were both charged with an appropriate task and with one which was filled with opportunity to really ferret out stuff. And we got support of the city's staff, not necessarily the loving support, but we got the support. And the reason I say that is that we would sometimes put a stick in their eye because we were skeptics. And we said, well, tell us again. But I'll give you an example. We really probed on this issue of airport, the use of general obligation money to support the airport bonds. Our coming out position was that sounded pretty funny. And so we poked and we poked and we poked, and we talked to the consultants and so on, and we finally came away with the idea that, in fact, providing that level of support with the assurance to the people who would buy the debt and who would then use it to be rated would actually benefit greatly. And so that's an example of the kind of discussion we had, and we went through that with a lot of different things. And so we feel well served by the process. And as I say, the staff was skeptical. I don't want to say, I should say one other thing, and that is when I was asked by Grant House at the council meeting if the city was well run, and because we said there could be some economies that were developed, I said, yeah, the managers were troubled that we would ask such questions, and they said already that Jim was already all over them like a bad smell. And it was a colloquial term because he doesn't have a bad smell. So I just wanted to make sure that someone didn't draw the wrong inference on that particular thing. We thought that this classification that the staff wrote of the different parts was just excellent. But what we brought was something called a potential approach, because as you've indicated, this is going to be back and forth between the Finance Committee and the staff. And so we did something called a potential approach for adopting resolutions. And we just put the resolutions in the same order that we had for our presentation. The thing that was critical there is we put the top 2 items, which are about finding the money for the funding of capital in the operating budget. It's a pay-as-you-go model. And the thing that hasn't changed for us, like the rest of the organization, is it was clear to us there is no silver bullet. And the financing methods, which rely upon interest, are going to be unpredictable and require massive financing efforts and cost analyses. And it seemed to us that we were barking up the wrong tree if we're going to use those methods. And that's why we finally settled on a recommendation which said, let's build annual accruals, which will get us up to an approximately $10 million a year expenditure on capital. Now, $10 million in a general fund per year is a lot of money. And that's why people said, well, gee, we can't carve that out of the operating budget. We said, you've got to find efficiencies. And the first thing that happened when we had that discussion, someone said, well, we'll have to cut back on programs. And that wasn't what we said. We said, look for efficiencies. Look for efficiencies in everything you do. It's a culture you develop. Sometimes in budgeting, and as Roger knows from his experience and mine, there is a process in which budgets in governmental organizations are primarily incremental. Everything starts from where it is this year, and we figure out where we're going relative to that the following year. That won't get you to this answer. You've got to go and ask, how can we reorganize what we're doing in order to get what we need? Now, I'll tell you the story of a lost opportunity at the University of California. We had something called VERIP. We had 3 of them, in fact, and a lot of people were able to retire. And when they retired, what ended up was many of them were replaced in kind. Where's the saving in that? The idea was to save. The campuses that had the savings were the ones that reorganized. Every time there was a personnel change at the top, they'd say, how can we shuffle the jobs among the departments and push down the classifications of the staff sufficient to keep the job done and allow people to move up in their careers, but at the same time, when someone moves out at the top in their career, you take another look at it. That's the staff side. I pointed out to you on the green thing, which caused everyone to get pushed out of shape, that you greened the garage on, I guess it's one of these buildings around here where all the greening's taking place, on the Corp Yard. And everyone said, well, yeah, we did that. Well, you didn't save any money. You're paying 4.5% more each year. Now, it's the expected amount you'd pay Southern California Edison. So that's, you're green, but you didn't save any money. The question is, how could you save the money? Well, I could tell you, if you started looking at the value of your capital over a long enough term, you could have made an investment in that even without the tax credits and gotten a better deal. But if you'd paired with a company that wanted to lease you the panels, they'd have gotten the tax credit, you'd gotten the incentive payments, and you'd paid less for it. So it's one of those things that I want to challenge you to say, it's not good enough to simply cut. We've got to find different ways of doing things. And I know you've got a commitment to that. Places run tough, but it's one of those things that can be explored more fully. And that's why our first 2 recommendations are the silver bullet, if you will. And that is that we suggest that you increase the efficiency of the items under your control in the operating budget, and get at least 2 or 3% out of that annually, and that's $2 million or so out of a $100 million budget. And you just take that and add it to the pool, and in 5 years or less, you'll have an annual $10 million amount. Now, I understand why you might say, well, why do we need that? Remember, you've got a $440 million capital budget, of which only a third is funded. But in the operating part, only 13% is funded. So you've got to find a source for that. And that's the most important part, because that's the maintenance part, which is running right now at $19 million. It's being decreased because of RDA funds. But you've got to find a way to fund those things, because whether it's the airport discussion or anything else, once you start going downhill, you can't catch up, Vallejo being the example. And so the critical element is that you make your investments while you've got some possibility of making it rather than later on. So we debated the heck out of these things. We really got after each other and came up with this set of things. But we thought that the first two are the most important. We thought this group right here could say, yes, we'd like to receive the report, say to the council, we receive the report, and we'd like the staff to develop the alternatives that we've noticed on the city staff action, the kinds of things that can be done. Some of them can be done, in fact, Bob and Scott Burns had redrafted the resolutions with respect to making them current. But there are a couple of things that we suggested in there that are going to be a little tougher, and that is that we use replacement value as describing what we do with the reserves rather than book value, which is much lower. Well, so there's some little things in there, but those are not as critical as those first two items. The other thing is that probably the most controversial item is the one with respect to the waterfront and recreation. Recreation has the biggest chunk of unmet needs in the capital budget. And they also are the most hand-to-mouth in your budget. They fund 30% of their budget with revenues that they charge, but they're still very much in your general fund pocket. At the same time, they're doing a lot of things at the waterfront on the ocean side of Carrillo, which look to us as if they could be done by the visitor serving facilities and the waterfront. And one only needs to look at who goes to the restaurants which generate the revenue that should serve the waterfront and its visitors and so on. And so as we looked at that, we said, there really needs to be a rebalancing of the arrangements here. And the lease revenue for that surely shouldn't subsidize slip fees. And we've heard a lot about whether slip fees are accurate or not. The question of whether they're accurate is almost irrelevant. What's important is, do the slip fees cover your costs of running the marina? That's why we say, well, let's take a hard look at this thing and see if indeed they do. We believe on the basis of our example that it doesn't, but we also have enough evidence from other cities and conversations with city managers that they're probably below the market as well. And that relates to the airplane thing that we just had a conversation about. Is it may be we're probably should be raising the fees because they're so far below the market. That wasn't our recommendation. The market size was simply an indication that there was a subsidy coming from somewhere else, and yet recreation was paying for things which probably could be handled by a source of revenue that was more related to the waterfront. And so a lot of these things we're saying, well, let's go hard at correcting these things with solid studies so that we don't have the back and forth about, well, is it or isn't it accurate? We can determine that pretty easily. Our task force couldn't determine it as easily because we don't have access to all the cost data. But I think that we hit upon a number of themes which are useful themes, which should serve you well. And as you say, things have changed a lot. But the crux of our recommendation was in the center of the situation we find ourselves in now, and that is a pay-as-you-go model. And we're so gratified by the fact that we don't have to wrestle with the Measure A and the Measure G thing, which are devoting a lot to roads. And as we pointed out, we learned from you that 50% of all the revenue that's coming to road repairs right now is coming from AG and a little bit from RDA. So those all needed replacement, and we're grateful for that. So as I say, we had a lot of fun. And it struck me that this report is not the sort of report that lends itself to the whole thing to discussion at a committee like this. Until you have the staff report, which might say, well, we think this is the stupidest idea we've ever heard, or here's an implication of what would happen if you implemented it. You can debate those kinds of things. And so I think it's important to accept it and tell the staff to bring back pieces to you as they can, rather than to try to do item by item. Thanks.
Dudley, did you want to add anything to Dick's comments, sir?
Yeah. Oh, sorry. Technologically challenged here. No, I think that Dick summarized it very well, and I think that we went back to the fact that, one, there is no silver bullet. There's no one answer. We looked around and only came up with one sort of really exotic financing idea, and that was to collateralize predictable revenue streams such as the gas taxes. And we really didn't like that because that's sort of robbing Peter to pay Paul. You take the money now, and then the money doesn't go into the general fund later on. We thought, I guess, that there were two basic elements of the strategy that we're recommending, which is very similar to what the Keston Institute down at USC has come up with in similar kinds of studies, is given the reluctance and difficulties passing new taxes, although we were gratified to see that A and G both passed by overwhelming majorities, or appear to have, that you can improve efficiency or raise revenues. And I think that our focus on the waterfront was because of, I think you were on the trip that we went down, and we went to the bathhouse down there and looked at it, and I think everybody was sort of uniformly sort of dismayed by the state of what was a pristine jewel for the waterfront. And so we then started thinking, well, how could we redo things to make things work better and, as Dick said, redistribute things. But I think he's summarized it, and I would say that the committee, which is a fairly diverse committee, nobody knew each other before the committee started meeting, I don't think, and we were unanimous on all of the recommendations that we presented to you.
Great. Certainly do appreciate your work. At this point, before we bring it back to the Finance Committee, I'd like to ask if there's public comment. I think we need to do that for a report of this nature. So if anybody would like to come up and comment, this is your time. And if not, then I'll bring it back to the committee. Bob?
Mr. Chair, members of the committee, again, I'd just like to reiterate what Mr. Jensen just said, which is that, staff's plan is to take the recommendations, how they've been characterized or categorized, I should say, both in the staff attachment to your agenda report and to the handout that the task force members presented to us today, and to develop a schedule, a time frame, a calendar, and take, this table would be a great place to start, and simply in that middle column where it says Finance Committee, would simply to be, for instance, to put some dates in there and to come back to you within a week or so, 2 weeks at most, with a calendar that would lay out in a particular order how staff thought that these could be considered by the committee and brought back to the Finance Committee for your discussion. And that's where we propose to go from here. And, over the course, as I said, of probably the next couple months, I think, get through all of these and then compile it into a series of recommendations to the full council, if that seems like a reasonable approach to the committee members.
I think I'd like to ask Mr. Armstrong maybe to come up and say a few words about, since he's heavily involved in this matter.
Actually, I basically what Bob indicated, I think, is we'll come back to you probably 2 weeks and say, here's our proposed schedule, how we want to work through these things. And I think I also want to emphasize that I think the one thing that's changed in the last couple months is the financial situation in the world and how it affects the city. And I think we're struggling right now with the impact of the financial crisis on the current year and next year's budget. And so it is going to affect, I think, how we can deal with a couple of the major recommendations here, because they, when we're facing major financial issues anyway. But I think I think the committee did an excellent job, or the task force did an excellent job of kind of laying it out. And some of these, it just may take us a couple more years to, not to come back with recommendations, but to implement, because when you're dealing with major multi-million-dollar financial issues anyway, it's just going to be harder to blend this in. And I think that's just realistic. The world has changed in the last 2 months, and how it has affected our finances has changed, and we have to take that into consideration. And also, on behalf of the finance staff, I'm going to be challenging them also to help me balance the budgets for this year and next year, and that's priority one. But we're going to try and also on a parallel track move forward with this and come first with a schedule and then bring it to you in an organized way.
Okay, I think Councilmember Schneider has some questions. I'm sure Ms. Falcone does as well. So please proceed.
Thank you. First, I want to thank the task force again for many, many months and many meetings of good thinking and debate, and to bring back some really good recommendations. And I agree that we need to look at these very seriously. I guess the question is, in terms of the timeline, as much as I'd love to have $10 million ready to go to pay for capital improvements next year, I don't see that happening right off the bat. But to at least have a schedule of how we can reach that goal over time is important, and especially in light of the current budget situation and our current structure. Couple of things come to mind. One is, in Washington, D.C., they're talking again of another stimulus package. It might be different this time in terms of how the money's allocated out. It might go towards municipal projects, for example, and certainly for us to stay on top of that and grab what we can and have that, because we'll have projects ready to go that if that funding is available as part of a stimulus package for local jobs and so forth, we'll want to be right in front of the line. It leads to one of my questions in terms of the prioritization of capital projects. I saw in both the staff report and the report from the task force the making the funding of a new police station and adequate fire and emergency disaster facilities the highest capital infrastructure priorities for the general fund. I completely agree with that. But there's a period there, and it doesn't go on. And what I remember from the report, it was one of the recommendations or comments was to prioritize everything. So if you look at the Parks and Recreation Department and their capital needs, there's dozens of projects, but we want to prioritize those as well. So that's not in either of these that I think somehow we're going to have to look at, and that's going to depend on funding opportunities and how close are we with plans. There's a lot of pieces to that, but I think that should be part of this as well. And did you want to comment on that first?
Yes. One of the things that we realized was how well the city was run with respect to having developed capital projects that could be funded when funds become available. And we saw this as opportunistic in a way that a lot of cities just aren't ready. And this city is ready, knows what it'd like to do, and so on. And yet, all of the projects on that list seem to have the same priority.
Right.
And so, if you have a choice, it's kind of like the council might do well to say, we'd really like to do these first if we can. And if there is actually money, then you say, yes, these are the ones we're going to do first. But yes, our proposed revision would include both categorizing whether something's planning or whether you're doing construction or whether you're doing equipping, on differentiating them a little, because right now it's all money is green, sort of a line across there. Right. But the other side of it is that the thing that we thought was important was that you would list them so that you could know which ones are we going to fund if we have the funds available. And that was something that was critical.
Yeah.
We have, sorry.
It's okay.
We have a series of management recommendations that were really a little beyond the scope of our project, but they impact all of the financial recommendations. And among them was that we recommended some improvements we thought that you could make in your capital budgeting system, really sort of borrowing from stuff that's already proven and already in place for the University of California, who have a very sophisticated system going out several years. And that would help, I think, in terms of prioritizing And it would also help, I think, the council a lot in knowing exactly where you are on some of these projects. So while we've got a rough dollar figure on a lot of these in terms of the current budget things, it's hard to tell where we really are on some of them in terms of the financing. Now, some of them are still in planning sessions and,
Right.
stages and things like that. And so I think we need to look at a sort of finer mesh, if you will, to evaluate the programs that are in the pipeline.
Okay, and I guess related to that, as we're looking at, Mr. Jensen mentioned organizational structure when there's staffing changes. I know some entities have a person dedicated to do research and grant proposals, and it appears our city has different individuals focusing on different pieces. We have someone for creeks, for example, someone under trash, someone who looks at parks and rec, but not one, and I don't know if that's the right answer, not to have one person there, but certainly if someone has 5 major job duties, one of which is to go forth and search out and find and other, whether it's government funds or grant opportunities, that might be difficult. We might be missing some opportunities. So I don't know if that's something if we want to look at down the line, not next year, but at some point. But it might might pay for itself in terms of its position.
At least in terms of parks and recreation, where you've got a history of public and private partnership with Ellings Park, that there didn't appear to be in the management and organization structure anybody who was particularly looking at private donors who was a really development office person. So the notion of perhaps, at least in some selective departments, having somebody who was in charge of development, which is such as you have with the Music Academy of the West. They have a development person at the Art Museum. They have a development person, and that's a full-time person whose job is to look for and raise money.
And
Don't know. We did not consider whether you wanted to have some overall development czar for the city as a whole.
yeah, and I wasn't just thinking of private donations, although that's part of it, but for example, Prop 84 and 1E bond funds that are coming up online. There's Prop 1B funds for transportation. I mean, there's a lot of these things that we just have to stay on top of. So I know we're running out of time. One question on, I think it's number 3, revise the capital reserve requirements to 5% of the estimated replacement value, ... Is this, to Mr. Pearson, getting rid finally of that $1 million capital reserve that's been there for eons that we've been wanting to update? Is that what this is referring to here?
Councilmember Schneider, yes, that's what it's referring to, but it's not referring to getting rid of it.
Well, it's changing it.
Yes,
but
it's
that $1
referring to
million that's
substantially
been there for a number of years
yes,
means
yes.
nothing anymore. So
That's
let's
correct.
change what the reserve looks like.
That's
okay.
the one.
Wanted to make sure that was there.
Yes.
And I think that just briefly on the issue of the waterfront and the Parks and Rec, I mean, that's going to be a very complex, I think, kind of big picture policy discussion. We'll need to know a lot more information before we make any final decisions, but I do appreciate your thinking in that way, and we'll have to see what kind of information comes back to us before moving forward, but it is something that we might want to look at, definitely want to look at more carefully. So with that, I'll be happy to make a motion when the time is appropriate.
I think that might be just about now, but I just did want to mention publicly the cooperation we have with the Junior League of Santa Barbara on the children's wing of the library, and what a wonderful opportunity that is for the kids of our community, and for us to have a group of women like that to be interested in helping us. And there are many other organizations in the town, Hutton Foundation, Orfalea Foundation, that do things like that. But we are very grateful to have the help of the Junior League with the library project. And picking up on what you say here, both Dick and Dudley, I think we can probably expand. And my own view from experience with Dick at the university is that it seems like you're generally better off to have people in the field keep their eyes open for things like that rather than have a central czar of development, but that's just a personal opinion. So I think I'm happy to accept a motion.
Did you second it?
I'll make a motion to receive the report and ask staff to come back with a timeline of implementation of the report.
Well, I'm happy to second it, Mr. Chair. I have a couple of comments.
Please, go ahead.
Very briefly. First of all, thank you to the committee, all the members who worked on it. It's yeoman's work, very difficult and very thorough, and very, very helpful. And it gives us probably not everything that we need, because there are lots of things in disarray, but this gives us a starting place and some excellent places to jump off of, to really consider. I like the idea of bringing it back in a compartmentalized, methodical fashion, so that we can really chew on and digest and give consideration to each one of these very important and really very complex issues. I also, there are some that I like right off the bat. There are some that I think are achievable. There are some that are, I think that a lot of the financial aspects are achievable, but I think that it also is going to involve a cooperation from the community that may involve special assessments in various different ways, and I don't know what that's going to look like, but I like the state government, which is in such bad shape. We're very lucky we don't have to take our marching orders from the state as the counties do. We are independent in that way. We did get Measure G and Measure A, which was brilliant of the people of Santa Barbara and the county of Santa Barbara to pass. It is important. We do need to take care of our infrastructure. They understand that, and this is part of that. This is just a more localized part. Now, the whole discussion about efficiencies, Mr. Armstrong, over the last 7 years that I've been here, but was here a couple of years before that, has set about quite aggressively for that entire time to find efficiencies. Some I agree with, some I don't, but that's irrelevant. But the organization is leaner and meaner and functions much more efficiently than it did due to a lot of the work that has been done. What you're asking us to do is take that to the next level. And one of the conversations that is sort of the big glaring one. There are lots of conversations like that. However, the big glaring one that sticks out at everybody is the relationship, the overlap, the interface between parks and waterfront, parks and recreation and waterfront. One idea that I've been sort of throwing out there for all this time. Sometimes it gets a little traction and sometimes it doesn't, but I'm going to keep at it because I think there's merit to the conversation. There is a reorganization down at the waterfront that probably should happen. Whether it happens in the way that you suggested or not, I don't think so, just initially, but maybe. We'll see how that goes. But that conversation needs to happen in earnest. What it also involves is the other jurisdictions of the South Coast that I know it's very hard to get someone who's never paid any money toward a service that they've gotten historically to suddenly say, oh, but it's the right thing to do, I think I'll put some money to it. But it's not unheard of. It's not unheard of. It's happened in the recent past, and I think it can happen under this circumstance. I'm talking about the area of recreation. Santa Barbara City has historically been the site of all the recreational activities, the programs, and so forth. And has paid the lion's share. However, that is an outdated model where all the people came to Santa Barbara. We instituted an in-city, out-of-city resident. That didn't really help. The entire system needs to be revamped and brought into the 21st century and into the regional aspect of the South Coast as it exists today. And that involves the conversations with Goleta, with the county, and with Carpinteria in earnest. I know that we're going to be doing that sort of collaborative discussion with the gang youth violence. There's some folks in Carpinteria and in Goleta that really want to partner with what we're doing so that it becomes a much more regional approach. So that's there for the taking as one of the next steps as we go forward. But recreation is an overarching thing that goes throughout the South Coast. And I really, truly believe that some sort of JPA, Joint Powers Agreement, or some other kind of arrangement is now. The time for it is ripe, and I think we need to have that as part of this package in this conversation. So I'd like the members of the task force, who I assume are not going to go out of our lives completely, that you'll still be around for suggestion and for expertise. I would very much like to ask if some of you would think about this in earnest and as part of the equation to look for better efficiencies. So, and I thank you very, very much. Look forward to taking this apart and figuring it out. So, thank you.
Okay, well, we have a motion and a second. If there's no further discussion, all in favor, please say aye.
Aye.
Aye. Motion carries, and thanks again, gentlemen, for your great report and service. Mr. Pearson, shall I adjourn the meeting?
Yes, please, sir.
Then we shall do so.